Houston, Texas, February 28th, 2026. A petroleum engineer named David sits in front of 3 monitors in his home office. He has spent 19 years studying oil. He knows the geological formations of the Permian Basin better than most people know their own neighborhood. He can read a seismic survey the way a conductor reads sheet music. He has a 401k allocated 80% to a diversified index fund, a broad basket of American stocks that his financial advisor called the smart, boring choice. He has a brokerage account holding exactly what the conventional wisdom of 2025 recommended: tech exposure, bonds, consumer discretionary, healthcare. A balanced portfolio, a responsible man's portfolio. He understood oil as a physical substance better than almost anyone in the country. What he did not understand was what oil does to financial markets when it explodes. That morning, at 3:47 a.m. local time, U.S. and Israeli forces launched coordinated strikes on Iranian nuclear and military infrastructure. By 6 a.m., crude oil futures were halted due to volatility. By noon, Brent crude had crossed $100 per barrel for the first time in years. By the end of the week, it was trading at $118. By April 2nd, it briefly touched $128, the largest single-week price surge since the 1990 Gulf War. The Strait of Hormuz, the narrow neck of water through which nearly 20% of the world's daily oil supply travels, had been effectively closed. David's diversified portfolio, his smart, boring choice, dropped 11% in 6 weeks. His neighbor, a 58-year-old retired airline mechanic named George, made 34% in the same period. George had not predicted the Iran conflict. George had not hired a geopolitical analyst. George had not read classified intelligence briefings. What George had done 7 years earlier, after watching oil spike during the Russia-Ukraine war in 2022, was read one book on commodity market history, notice a pattern, and quietly position a portion of his savings into 3 specific assets before anyone was talking about the Middle East. Most people watching this will assume that George got lucky, that it was timing and coincidence, that it could not be replicated. Most people are wrong. What George recognized was not a prediction. It was a pattern that has repeated with such mechanical precision across so many decades and so many continents that calling it luck is like calling gravity a coincidence. The same 3 assets have surged in every major oil shock since 1973. Not approximately the same, not conceptually similar. The same categories, the same sequence, the same mechanism, 6 separate times. 6 separate geopolitical triggers, 6 separate decades, one pattern. This channel does not predict the future. It performs autopsies on the past. And what the autopsy of every oil price explosion in recorded history reveals is both simpler and more structurally sound than anything your financial advisor has ever built into your model portfolio. Let's begin with understanding what an oil shock actually is, because almost everyone who loses money during one has fundamentally misread the mechanism. An oil shock is not a commodity price event. This is the misunderstanding that costs people fortunes. Investors who frame oil shocks as sector-specific stories, as something that affects energy companies and airline stocks and perhaps gasoline prices, are looking at the shadow and calling it the object. Oil is not a product that competes with other products. Oil is the input cost of every product on Earth simultaneously. It is embedded in the plastic housing of your phone, in the synthetic fiber of your jacket, in the fertilizer that grew the wheat that made your bread, in the fuel of every truck that delivered every item in every store you have ever entered. When oil doubles, the cost structure of the entire global economy shifts. Not sequentially, not sector by sector, but simultaneously and instantly. The 1973 OPEC embargo is the archetype. In roughly 4 months, the price of crude oil rose from $3 per barrel to nearly $12 globally, a 300% surge, the U.S. economy already running hot with inflation at 3%. 4% could not absorb the blow. GDP contracted. Unemployment climbed from 4.14%. 6% to 9% by May 1975. The Federal Reserve raised its benchmark rate from 75% in 1972 to 12% by 1974 and still could not contain prices. The result was stagflation, high inflation, high unemployment, and slow economic growth simultaneously. That combination, the most toxic in economics, was not caused by anything that broke inside the financial system. It was caused by a disruption to one physical choke point, one narrow strait, one politically motivated production cut. Now consider 2026. Brent crude oil began the year at $61 per barrel and finished the first quarter at $118, the largest inflation-adjusted quarterly price increase in data going back to 1988. Global oil supply plunged by an estimated 8 million barrels per day in March, with curtailments across Iraq, Qatar, Kuwait, the UAE, and Saudi Arabia. By April 12, 2026, U.S. crude oil reached over $111 per barrel, the biggest jump in 6 years. This is not a hypothetical exercise. The shock is not coming. It has arrived. You are reading this inside the event. And the three assets about to be examined are not theoretical crisis hedges waiting to be activated. They are performing right now, in real time, in April 2026, exactly as they performed in 1973, in 1979, in 1990, in 2003, and in 2022. The mechanism is always identical. Only the country names and the headlines change. Part 1, gold, the asset that has survived every oil shock in history, but not for the reason they tell you. Washington, D.C. August 15th, 1971. Richard Nixon sits before a television camera and announces that the United States will no longer convert dollars into gold at a fixed rate. The Bretton Woods system, the global monetary architecture that had pegged every major currency to the dollar and the dollar to gold at $35 per ounce, is dead. That single announcement did more to determine what happened in 1973, 1979, and in every subsequent oil shock than any OPEC meeting ever held. Here is why. And this is the mechanism that almost no financial commentary ever explains correctly. Before 1971, oil was priced in dollars. Dollars were backed by gold. So in economic reality, oil was priced in gold. OPEC nations knew what their oil was worth in terms of the physical metal that had backed monetary systems for 5,000 years. After 1971, dollars were backed by nothing. The dollar's value began to fall against gold. It took $35 to buy an ounce of gold in 1970. By May 1973, it took about $100. The dollar's value was approximately one-third of its prior value compared to gold. Just to catch up to this decline in dollar value, oil prices had to triple. This happened soon afterwards, triggered by the Arab oil embargo of 1973. Read that again. The 1973 oil shock was not only a geopolitical event. It was, at its monetary core, a repricing of oil out of a debased currency and back toward gold's real purchasing power. OPEC was not simply punishing American foreign policy. OPEC was correcting the price of oil after 2 years of watching their revenues shrink in real terms because the dollar was losing its value against gold. At the start of the decade, gold was locked at $35 per ounce under the Bretton Woods system. The OPEC oil embargo of October 1973 quadrupled energy prices overnight. Energy prices rose 21, 6% in 1974 alone, and 37, 4% in 1979. The Federal Reserve's response made it worse. Rates stayed too low for too long, and inflation ran above 6% for the full decade, peaking above 11% in 1974 and above 13% by 1980. Gold's response to that sequence was not subtle. In 1973 alone, gold surged 70%. During the 1979 Iranian Revolution, gold went up 278%. By the end of the decade, the metal that had been fixed at $35 per ounce in 1970 was trading at $850 per ounce in January 1980. Not 70% up, not 100% up, 2,300% up over the decade. Now here is the precise explanation that separates the investors who held gold correctly through the 2026 shock from the ones who panic sold in March and watched it recover in April. Gold does not rise primarily because people are frightened. Gold rises because the real value of paper money falls, and it falls fastest when oil is embedding higher costs into every category of goods simultaneously. That is the mechanism. It is an inflation mechanism, not a fear mechanism. The distinction is not academic. Fear is temporary. Inflation, once embedded into cost structures, is persistent. When oil surged above $100 in early 2026, the combination of a stronger dollar and rising bond yields temporarily outweighed safe haven demand and actually hurt gold through parts of March. Investors panicked. They sold. Commentators called it broken. They called gold's underperformance proof that the crisis hedge thesis was wrong. It was not wrong. It was the acute phase of the oil shock behaving exactly as it has behaved in every prior instance. In the first weeks of a crisis, capital rushes into the dollar, the world's emergency reserve currency. The dollar competes with gold. Gold temporarily underperforms. Then, as the inflationary consequences of sustained high oil prices begin filtering through consumer price indexes, through supply chains, through corporate earnings, the dollar's real purchasing power erodes. Central banks face impossible choices between fighting inflation and preventing recession. And gold resumes its structural trajectory. State Street's gold strategy team noted that if oil prices normalize toward $80 to $85 per barrel, gold could quickly move back above $5,000 per ounce. And the structural factors that have supported gold, specifically larger sovereign debt burdens and wider fiscal deficits, could be exacerbated rather than resolved by the current conflict. J. P. Morgan analysts, in a research note published in early 2026, stated that they remain bullish on gold and expect it to hit $6,300 by year-end, noting that conflict-driven surges in gold come and go. but that geopolitical risks broadly are likely to stay elevated. The 1973 investor who understood the mechanism did not sell gold when OPEC lifted the embargo in March 1974. Because the mechanism, a debased dollar, structurally higher oil costs, embedded inflation, a Federal Reserve behind the curve, had not resolved. It had deepened. Oil prices never fell back after the embargo ended. They stood at around $3, $50 before the crisis, and $11, $50 afterwards, and then continued rising, reaching nearly $40 per barrel by 1980. Gold followed oil's refusal to retreat. It held, it compounded, for 7 consecutive years. You're not looking at a trade. You're looking at the most reliable inflation hedge ever constructed by markets, performing right now in 2026, precisely as it has in every prior instance of sustained oil disruption across the last 5 decades. Part 2. Defense stocks, the asset that turns every geopolitical crisis into a multi-year revenue stream. Bethesda, Maryland, February 24th, 2022. Lockheed Martin's stock opens at $4 per share. Russia has just invaded Ukraine. Oil has begun climbing toward $130. NATO nations, having spent 3 decades systematically dismantling their Cold War military infrastructure on the assumption that permanent peace had arrived, suddenly realize they have a problem. Their inventories are low. Their manufacturing capacity is insufficient. Their procurement pipelines are empty. The gap between what European NATO members are spending on defense and what they have committed to spending under the 2% of GDP agreement is measured not in billions, but in decades of deferred investment. Lockheed Martin closes the year at $480 per share, a 5% return in a year when the S&P 500 fell 19%. Northrop Grumman returned 38% that year. Raytheon returned 22%. The entire defense sector, the sector that most retail investors treat as a niche, as an ethical complication, as something to hold in small allocations, if at all, outperformed the broad market by approximately 55 percentage points in a single calendar year. This is not a 2022 phenomenon. It is a structural one, and the structure becomes visible when you examine what actually happens to defense budgets after every major geopolitical oil shock. The 1973 OPEC embargo did not simply embarrass American foreign policy. It permanently restructured American military strategy in the Middle East. Within 5 years, the United States had begun building what would become Central Command, the dedicated military structure for projecting force in the Persian Gulf region. That restructuring required procurement. Procurement required contractors. The defense sector that benefited from the Cold War buildup of the 1970s and 1980s did not benefit because of the Cold War alone. It benefited because an oil shock in 1973 had permanently altered American strategic calculations. The 1979 Iranian Revolution and the subsequent Iran-Iraq War produced the same sequence. American military presence in the Gulf region expanded. Defense budgets, already rising, accelerated further. The Iranian Revolution removed Iranian supply for much of 1979, and the Iran-Iraq War that followed extended the disruption into the 1980s. These were multi-year disruptions that forced structural changes. Manufacturers to reprice inputs, households to slash consumption, and central banks to make crisis decisions in real time. And governments to permanently revise their defense postures upward. The Gulf War of 1990, the Iraq War of 2003, the Russian invasion of Ukraine in 2022. Each geopolitical oil shock has been followed not just by an immediate surge in defense stocks, but by a sustained multi-year increase in government defense procurement that created durable earnings growth for the companies manufacturing that equipment. This is the mechanism that retail investors miss. They see defense stocks surge during the crisis and assume the trade is the crisis. It isn't. The crisis is the catalyst. The trade is the multi-year procurement cycle that follows the crisis, because governments do not rearm instantaneously. They sign contracts that span 5, 7, 10 years. They fund programs that extend across multiple budget cycles. The earnings visibility for a major defense contractor after a geopolitical realignment event is not a quarter. It is a decade. Now look at the current environment with that lens. U.S. defense outlays are projected to surpass the $1 trillion milestone for the first time in 2026, driven by a massive modernization cycle in missile defense and naval capabilities as Western nations pivot toward what analysts are calling a new strategic posture. Companies producing autonomous underwater vehicles and mine countermeasure systems have seen dramatically increased interest from both the U.S. Navy and allied forces. Because the specific nature of this crisis, with sophisticated mines deployed in the Strait of Hormuz, has created immediate urgent demand for exactly those capabilities. Lockheed Martin is up 9% year-to-date in 2026 as the Iran conflict escalates. Defense stocks have been a crisis winner for 50 consecutive years. But here is what the simple narrative misses. The nations most urgently re-examining their defense postures in response to the 2026 Strait of Hormuz closure are not only the United States and Israel. They are every nation whose energy supply transits that choke point. Japan, South Korea, India, Western Europe. Every economy that depends on Middle Eastern crude moving through a 21-mile-wide channel is now reassessing what its national security apparatus needs to look like if that channel cannot be assumed to remain open. That reassessment is not a few months of elevated defense spending. It is a generational recalibration. Japan has already passed multiple defense budget expansions. South Korea has accelerated its indigenous weapons development programs. European NATO members, already under pressure to hit their 2% GDP spending commitments following Ukraine, are now facing a second consecutive argument for why underspending on defense is a strategic liability they cannot afford. This shift has profound fiscal implications. The surge in defense spending is expected to push federal deficits higher. And with interest payments now the second largest federal expense, markets are becoming increasingly sensitive to the fiscal trajectory. But for defense contractors, for the companies holding the long-term contracts, the classified programs, the sole source procurement relationships that governments rely on because there is no alternative supplier, fiscal pressure on governments does not reduce defense revenue. It redirects it. Essential programs get funded, discretionary spending gets cut, defense companies sit in the essential column. You're not buying a crisis trade. You're buying the institutional consequence of the crisis, and that consequence outlasts the crisis itself by years. Part 3. The oil majors. The most obvious play that almost no retail investor actually executes correctly. Dallas, Texas, January 2nd, 2022. ExxonMobil opens the year at $61.04 per share. Russia's military buildup on the Ukrainian border is visible in satellite imagery. Oil is trading around $77 per barrel. Most financial commentators are focused on Federal Reserve tightening, on the end of COVID liquidity, on tech stock valuations. Energy stocks are not the conversation. Energy is 8% of the S&P 500 weighting, a rounding error in most institutional portfolios. Russia invades Ukraine on February 24th. Oil surges toward $130 per barrel, and ExxonMobil ends the year at $110.12 per share. That is an 4% return in 12 months. In a year when the S&P 500 fell 2%. In a year when technology stocks were down 30, 40, sometimes 60%. ConocoPhillips returned 7% in 2022. Chevron returned 5%. The investors who held these companies in proportion to their S&P 500 weight, roughly 3 to 4% of a diversified portfolio, captured perhaps 3% of those gains while watching the rest of their portfolio decline. The return was available, the allocation was not. This is the structural failure of conventional portfolio diversification during oil shocks. Diversification is optimized for normal conditions. Oil shocks are not normal conditions. They are the specific environment in which the correlation assumptions underlying diversification break down, where assets that normally move together suddenly diverge, and where the sector that conventional portfolios systematically underweight is the one that generates the largest absolute returns. Now understand why the mechanism works the way it does. When oil doubles, the revenue of an oil company roughly doubles. This is not because oil companies sell twice as much oil. They sell approximately the same volume. It is because the price of each barrel they sell has doubled. Meanwhile, their costs do not double. The wells are already drilled. The pipelines are already built. The refineries are already running. The capital expenditure that created the infrastructure is sunk. What changes is the margin, the spread between what it costs to produce a barrel and what the market pays for it. And that margin expands enormously, almost instantaneously, when oil prices surge. In 1973, Exxon replaced General Motors as the world's largest corporation by revenue. Not gradually, not eventually, but in that single year. A 50-50 basket of Exxon and Chevron bought at the start of the 1970s and held through 1980 returned 236% against the S&P 500's 47% over the same decade. The mechanism repeats with every crisis because the underlying economics are always the same. The oil is in the ground. The infrastructure to extract it exists. The market's willingness to pay for it has just increased dramatically. Every barrel becomes more valuable. Every dollar of revenue becomes more profitable. The earnings surprise that oil majors deliver in the first quarter of a major oil shock is typically the largest positive earnings surprise of any sector in any environment in financial markets. Not because they did something clever, because the price of their primary product doubled. But there is a dimension of the oil shock trade that most retail investors overlook entirely, and it is arguably more important over a 3 to 5 year horizon than the majors themselves, the oil services companies. When oil prices surge, every energy company in the world accelerates its production. Every idle rig gets reactivated. Every marginal field that was uneconomic at $60 per barrel suddenly becomes highly profitable at $110. Companies like SLB, formerly Schlumberger, and Halliburton do not simply benefit from current production levels. They benefit from the multi-year capital expenditure cycle that high oil prices trigger. When producers decide to drill more wells, they sign contracts with service companies. Those contracts are measured in quarters and years. The revenue is durable, the earnings are visible, the backlog is announced in concrete. The oil services ETF, OIH, is up 39% year-to-date in 2026. SLB returned 74%, 5% in 2022 during the Russia-Ukraine oil shock. The EIA now expects global oil disruptions to continue through late 2026, putting sustained upward pressure on prices throughout that period, with Brent crude projected to average $115 per barrel in the second quarter, before gradually declining. That is not a spike. A spike is days or weeks. That is a sustained plateau across 2 consecutive quarters, precisely the environment in which oil services companies convert elevated activity into booked revenue that compounds across their order books. There is one exception to this pattern that the historical record identifies clearly, and intellectual honesty requires naming it. The 2008 oil spike, when oil reached $147 per barrel, saw energy stocks disconnect from oil prices above $100. The market correctly sensed the spike was unsustainable. By year-end, energy stocks had given back most of their gains. The lesson? Watch for demand destruction signals. If the economy is breaking, even oil stocks will not save you. The 2008 exception is important precisely because it reveals the conditions under which the pattern fails. Oil peaked in 2008 as the global financial system was simultaneously collapsing. Demand destruction, the economic contraction that reduces oil consumption, overtook the supply dynamics. The physical asset was becoming more scarce, but the demand for it was evaporating faster. Those 2 forces collided. In 2026, the situation is structurally different. The supply disruption is not speculative. It is not driven by futures market positioning or hedge fund momentum. The disruption involves the shutdown of more than 4 million barrels per day of refining capacity and the effective closure of a waterway that handles 1/5 of global oil supply. This is physical infrastructure being physically disabled. There is no financial instrument that resolves that. There is no rate cut that reopens the Strait of Hormuz. There is no policy statement that fabricates the barrels that have been shut in. The framework? Why these 3? Why always these 3? Step back from the individual assets and look at what connects them across 53 years of oil price explosions. Because the connection is not coincidence, it is architecture. Every major oil shock in recorded history has been the simultaneous occurrence of 3 specific economic events. An inflation shock because oil's cost is embedded in the input structure of the entire global economy. A geopolitical rupture because oil shocks do not occur during peaceful, diplomatically stable periods. They occur when a geopolitical fracture becomes severe enough to disrupt physical energy infrastructure. And a supply destruction event, because, by definition, a shock means less oil is reaching markets than markets expected. Gold is the asset that benefits from the inflation shock. Defense is the asset that benefits from the geopolitical rupture. Energy majors and oil services are the assets that benefit directly from the supply destruction event. Because supply destruction means the oil still flowing is worth more, and the companies extracting it capture that incremental value immediately in their earnings. The 3 assets do not simply happen to surge together during oil shocks. They address the 3 simultaneous consequences of the same event. They are not correlated in normal market conditions. Gold, defense contractors, and oil companies do not typically move together when the economy is growing quietly and geopolitics are calm. But when oil explodes, and oil only explodes when all 3 conditions arrive simultaneously. The assets that address each of those conditions surge in concert, while the rest of the market struggles to price what it is experiencing. Carmen Reinhardt and Kenneth Rogoff, in their study of 8 centuries of financial crisis, document the consistent pattern of what they call the "this time is different" syndrome. The persistent belief of investors in each crisis that current conditions are too modern, too sophisticated, too institutionally managed to reproduce the patterns of prior crises. The belief that this oil shock is different from the last one, that this geopolitical rupture will resolve faster, that diversified portfolios have evolved past the vulnerabilities they showed in 1973 and 1979. The data does not support that belief. 6 crises documented from 1973 to 2026. Oil majors and oil services win in every single crisis. Defense wins every time there's a geopolitical trigger. Gold wins 4 out of 5. The S&P 500, broadly held, broadly diversified, gets compressed every time. Morgan Stanley's chief cross-asset strategist noted something that deserves more attention than the financial press gave it. In a stagflationary setup, rising inflation combined with slowing growth, traditional diversification breaks down. Bonds fail to offset equity losses because inflation is rising at the same time growth is slowing. Diversification becomes hardest to rely on precisely when investors need it most. This is the structural trap that David, the petroleum engineer, fell into. Not through ignorance of oil. He understood oil better than almost anyone, but through a fundamental misunderstanding of what oil shocks do to financial markets. A misunderstanding that his financial advisor's model portfolio had quietly institutionalized. The advisor was not incompetent. The advisor was optimized for stable conditions. And the model portfolio that is optimal for stable conditions is precisely the portfolio that underperforms most severely when stability ends. Tim Harford, in his study of systemic adaptation, identifies what he calls the core failure of complex systems under stress, the tendency of agents within a system to optimize for the system's normal operating conditions to such a degree that they build in catastrophic vulnerability to abnormal ones. The diversified index fund is the financial market expression of that failure. It is optimal for normal conditions. It is structurally underexposed to the assets that address abnormal ones. The abnormal condition that oil shocks create has not changed in 50 years. The assets that benefit from it have not changed in 50 years. What changes, every single time, is the specific geopolitical trigger, the specific country, the specific choke point, the specific news headline that causes the next generation of David the petroleum engineers to believe that this time is different, that their diversified portfolio has evolved past the vulnerability, that the pattern that manifested in 1973, 1979, 1990, 2003, and 2022 will not manifest again because the geopolitics of 2026 are somehow structurally different from the geopolitics of 1973. They are not. The Federal Reserve's own historical analysis of the 1973-74 oil shock noted that the disruption came at a most inopportune time. When wholesale prices were already rising at an annual rate of more than 10%, industrial plant was operating at virtually full capacity, and many major industrial materials were already in extremely short supply. Replace those specifics with 2026's, an inflation environment still above target from the post-COVID period, a Federal Reserve already uncertain about its next move, global inventories that were beginning to build before the conflict interrupted the accumulation, and the structural rhyme between 1973 and today becomes difficult to dismiss. A financial commentator studying the 1973 parallel wrote in early 2026, if you take the 1973 experience as an example, not only did oil prices go up, they did not go back down. After the embargo ended in March 1974, oil prices in early 1978 were still around $15 per barrel, roughly 4 times what people had been accustomed to before the crisis. The assets that benefited from the 1973 shock did not stop benefiting when the embargo was lifted. They benefited from the entire period of structurally elevated oil prices that followed, through 1974, through 1975, through the late 1970s, until the Volcker shock of 1981 finally broke the inflationary cycle that the 1973 oil disruption had begun. George, the retired airline mechanic who returned 34% in 6 weeks while David's diversified portfolio lost 11%, did not predict the Iran conflict. He recognized the pattern. He understood that oil shocks are not random chaos. They are a specific kind of economic event with consistent consequences, and that those consequences have been addressed by the same 3 categories of assets in every instance for over half a century. David understood oil better than George, but George understood markets better than David. The distinction cost one of them 11% and made the other 34%. You came into this video asking which assets surge when oil prices explode. The real question is why they surge. Why the same 3 have surged in every oil shock across 5 decades and 6 continents, regardless of who was in the White House, regardless of which central bank was tightening or loosening, regardless of which country was the belligerent and which was the victim. The answer is structural. Oil shocks are not random events with random consequences. They are a specific type of disruption. Always geopolitical in origin, always inflationary in consequence, always supply destructive in mechanism, that produces consistent economic effects across every instance in which they have occurred. And the assets that address those effects directly, that benefit from the specific dislocations that oil shocks create, have been consistent because the dislocations themselves have been consistent. Gold addresses the inflation dislocation. Defense addresses the geopolitical dislocation. The energy majors and oil services address the supply dislocation. 3 assets, 3 mechanisms, 53 years of confirming data, 6 separate crises, 1 pattern. The investors who captured that pattern in 1973 were not more intelligent than the ones who didn't. They were not luckier. They were better calibrated to what history had already established, that the economic consequences of oil shocks follow recognizable paths, that the financial assets which benefit from those paths are identifiable in advance, and that the conventional diversified portfolio is structurally unprepared for the environment that oil shocks create. Today is April 13th, 2026. The Strait of Hormuz remains effectively closed. U.S. inflation has climbed to 3%, the highest since May 2024, with the monthly index surging 9%, the steepest rise since mid-2022. Defense budgets are being revised upward across NATO and the Indo-Pacific simultaneously. Oil services companies are signing contracts against a backdrop of structurally higher, sustained crude prices. You're not before this event, you're inside it. The question is not whether the pattern exists. 53 years of documented financial history answers that question without ambiguity. The question is the same one that the investors of 1973, 1979, 1990, and 2022 faced in the first weeks of each of those shocks, whether you will recognize the pattern while you are still inside it or only after. History has been teaching this lesson in every decade, in every currency, in every geopolitical theater, to every generation of investors who believed the current moment was too sophisticated, too different, too institutionally managed to reproduce what came before. It always reproduces. The mechanism does not care about the sophistication of the institutions. It cares about physics, about the physical reality that oil flows through choke points, that choke points can be disrupted, that disruption creates inflation, that inflation benefits assets that exist outside paper currency, that geopolitical rupture triggers defense investment, that supply destruction enriches the companies that control the supply that remains. These are not financial theories. They are physical facts, expressed in market prices. They have been expressed 6 separate times in the last 50 years. In every language, on every continent, under every political system that tried to insulate itself from the pattern and discovered it could not. This channel performs economic autopsies, so you understand the mechanism before you become the next case study. If that matters to you, subscribe. The next analysis is already being written, and the pattern we examine next is one that is forming right now in the data, quietly and without headlines, the way every pattern does before it becomes obvious. This is historical and educational analysis only. It is not financial advice and should not be construed as a recommendation to buy, sell, or hold any specific security or asset class. All investing involves risk. Past performance does not guarantee future results. Consult a qualified financial professional before making investment decisions.